Today, international banker is joined by Giles Edwards, Senior Director of S&P Global Ratings, to discuss banking market turmoil, ECB monetary policy, and incorporating ESG factors into ratings. Giles, very good to have you with us today. Now, I understand that Europe is your primary geographical focus within the financial institution sector. How vulnerable is this region's banking sector to another financial crisis, particularly in the wake of Credit Suisse's trouble and the banking collapse in the United States? And how can you provide insight into how you measure contagion risks?
Measuring contagion risk is it's very hard to put a number on contagion, isn't it? I think, clearly it's been very febrile, jittery markets the last few months. Maybe eased off a bit, but certainly March was a roller coaster. We've, in terms of contagion, clearly banks are highly leveraged, confidence-sensitive institutions and always going to be vulnerable. And in some respects, the facts, may not matter, if sentiment is against banks. Equally, the authorities' financial stability is absolutely paramount, and they've, I think, stepped in to the extent that they felt they needed to, but equally not waded into it, and which can itself cause question marks over what are people worried about. When we think about contagion, ultimately there has to be a linkage, has to be a domino effect, if you like, and the banks themselves are, when they face each other, are collateralized these days rather than uncollateralized. A lot of exposure goes either through central banks in terms of lending and also clearing houses. So, some of that connectivity clearly still exists, but some of it has reduced over time. And if we think about other causes of contagion, we need the similarity, I suppose, of business models. Particularly narrow business models lead to more vulnerability. Concentration kills banks ultimately. Concentrations, whether it's credit concentrations or business or funding. So as we've looked through the sector, the rated sector, at least the names we know, through March, April, and ultimately we're happy that we couldn't see the type of vulnerabilities that have been shown up in the US. Equally, there are clearly some banks that have some of those characteristics, but it's very hard to find banks that have tick more than one of those boxes.
Now, you recently commented on the banking crisis management framework that followed the banking market's turmoil in March, particularly, if you like, the future resolvability of global systematically important banks. Has this event caused S&P Global Ratings to reevaluate its view on the bailout versus bail-in question?
Yeah, so maybe if I start by saying where we are, and since 2015, we've basically said government support for commercial banks rather than policy institutions. Commercial banks is uncertain, which never say never, but it's, let's say, unlikely or less likely than it used to be. And therefore we've been factoring resolution, loss absorbing capacity, bail-in and so on as the backstop in terms of what if a systemic bank fails. So have we revisited that? The answer is no. Equally, even before March, there would have been plenty of investors around who would doubt that bailout has actually gone away. They're still assuming that governments are there to backstop the banks if it really comes to it. But when we looked at what happened in March, ultimately we saw nothing there that's really changed our minds. Policymakers, so financial stability is paramount. Authorities have stepped in to preserve that. Governments providing liquidity backstops is, in a way, a good institutional framework. It's not a bailout in the way that we think about it. So we haven't changed anything. Equally, we do find it interesting that the Swiss authorities felt that resolution was not a tool that they wished to use in those circumstances. It wouldn't have necessarily ensured financial stability in their view, and that will have redoubled the existing doubts in the market about, are they really serious about this? So we've, keeping a close eye in terms of the policy response. So far it's been relatively muted. Some discussion in the US, UK around deposit guarantee scheme, maybe tweaks to that. The EU CMDI package on crisis management, deposit insurance, that's been in train for a long time, but the policy announcements come out now. That's arguably a doubling down on making resolution work. So there's nothing really there that's changing our minds, but it's a dynamic situation, and ultimately a lot of it's down to behaviour. You can build the framework, a resolution framework. It's ultimately a toolkit. The question is, will it be used when it comes to it?
So it requires kind of constant supervision, really, doesn't it?
Yeah, and it requires, I think, what it requires, I mean, a lot of it hasn't been tested. I mean, sorting out smallish institutions, even up to the size of Banco Popular in 2017, that's been tried, selling failed banks to bigger banks. What's not been tried is bail-in of big systemic banks, writing off, tens of billions of debt, particularly, senior debt, forget the AT1s, senior debt, that has not been tried yet. And what it takes ultimately is for resolution to work is essentially that it shouldn't be a surprise. And, so I think what we really look for is for policymakers to make sure that their intention is extra clear, and to guide market expectations, so that ultimately even the first bail-in will be a surprise to some parties, but it hopefully will be the smallest surprise possible.
Now, in January 2022, you were the primary credit analyst for S&P Global Ratings Research. The top trends shaping European bank ratings in 2022. And in that, one of the key forecasts was that at least 80% of the largest European banks had stable outlooks, and that there would be substantial predictability for the sector's profitability, asset quality, capitalisation and funding in 2022, amid an expected supportive economic backdrop and favourable financing conditions. Now, more than a year later, would you say this forecast has held up well? And how does 2023 look in terms of expectations and outlooks?
So I think, I had looked back last week at rating actions we took last year. And we had more upgrades than downgrades by a long way. It's not to say there were lots, but no, definitely more upgrades. And I think to some extent that's continued through this year. Rising rate environment has been supportive for bank earnings, no question. There's clearly a question mark about asset quality. We still see that as probably not this year thing, more next year in terms of rising non-performing assets. And even through last year and this year, there's still a story of recovery to some extent. Banks, peripheral banks, completing the job on non-performing assets, legacy non-performing assets, and getting their funding profiles right. Some banks who've gone away and done some hard work on their business models, structural profitability. The Deutsche Banks or the NatWests have now come back, Barclays as well. So we've had, let's say, idiosyncratic, a few trends, but idiosyncratic upgrades, as well as also the building of bail-in buffers, and that clearly has supported our view for senior ratings.
Now, turning to the European Central Bank, how aggressive do you predict their monetary policy will be for the rest of 2023? And how do you see this policy impacting the profitability and balance sheets of the Eurozone financial institutions?
So our economists are probably reasonably middle of the pack, and that they would expect another rate rise to 3.5% on the deposit rate around the middle of the year. I think there's a question mark as to whether it then goes a little higher. Even then, they're not expecting core inflation to come down into the ECB's desired range and for at least a further year after that. Now, but equally, the deposit rate is a fraction of the story. We've still got the wind down of TLTRO. We think that's going to be seen through. We've still got the quantitative tightening. There's huge buffers of bonds that need to be unwound. And then there's also sort of auctions of money, which essentially is a limitless at the minute. Ultimately, the ECB want to bring that back. So there's a long road yet on monetary policy normalisation. And then there's also on fiscal policy, although there's next-gen EU funds still to be spent, I think public authorities are very mindful of the need to ensure that close handle on fiscal policy as well and not overspending. I think what that points to ultimately is, constrained economic growth this year, maybe slightly improving next year, certainly as our economists would see it, but probably an end to that improving story of net interest margin for banks as we go through the back end of this year into next year. A bit more pressure on asset quality through next year, and also cost pressure on operating expenses. So, it may be, it's very hard to generalise, but it may be that this year looks as good as it gets in terms of profitability for a number of banks. There's a bit more pressure, a bit less support on revenues next year, a bit more pressure on the other factors, which still wouldn't be necessarily too bad, but yeah, this could be this could be as good as it gets for now.
Okay. Now, many would say that European banking was mired in a serious debt crisis around 10 years ago, particularly concentrated in southern European economies. Are you confident today that this crisis has been sufficiently contained and alleviated?
Yeah, I think we see huge progress over the last 10 years in the banking union. Ultimately, the banking union remains incomplete. There's no EDIS, European Deposit Insurance Scheme, yet, and still seems like a distant notion. But the creation of the single supervisory mechanism clearly has had a huge impact, added huge credibility, consistency in supervision and standard setting as well. And the ECB's really driven the banks very hard over the last 5 years to clean up legacy non-performing assets, and that's what's happened. Now, a reasonably supportive economic environment has helped as well, up until 2020 certainly, as well as some government schemes to take the bad assets off. So it's been a sort of joined up effort, but one reason why we've upgraded Irish banks, some Spanish banks, Greek and so on, over the last few years is exactly down to the progress that's been made.
Okay, well, let's turn to Germany. How much optimism do you hold for its banking sector over the next few years, especially given the profitability challenges it's faced in recent years and the highly publicised failings of its biggest lender?
I mean, Germany is a tough market. It's a tough banking market. It's got a very unusual structure to it. With the policy institutions, the two huge savings banks or cooperative bank groups, mutual groups, and then everybody else and all the other commercial banks. It's a very hard market to make good margin, and there's a lot of competition coming from outside Germany for German deposits. So it's unusual and one of the tougher markets in Europe to make good money for a bank. Equally, we've actually put Deutsche Bank on a positive outlook recently. We've seen some progress in terms of the heavy lifting that they've done over the last few years. Commerzbank, we've got our eye on as well. Having brought their rating down in previous years. It's long, hard work. It requires for commercial banks to be structurally in a good place, to be work very hard on efficiency, and they're getting a bit more help now on revenues, particularly net interest margin, and that's alleviating some of the pressure.
Now, how does S&P Global Ratings incorporate ESG factors into its ratings?
Yeah, so we get asked this question a lot about where's the ESG in the rating, and I think ultimately from a rating perspective, ESG factors have to matter to sort of fundamental credit, and really nothing there really has changed. The poor governance, that's always been there, right? Social failings, mis-selling, that kind of thing, that's not a new thing either. I think the newest thing arguably is around the environmental side, green transition. So, we've worked to increase the transparency in terms of saying this rating action is linked to ESG factors if you find ESG important, or this bank has better than average on these sort of factors or worse than average on these factors. So we've worked to increase transparency, I suppose. In terms of how we actually analyse banks, we haven't changed methodology. What we have changed, of course, is we're asking a lot more questions these days about green transition, sustainable finance, looking at bank disclosures as well in terms of what they're doing, looking at what regulators are expecting. But fundamentally, what's really the extent to which ESG drives rating actions is still, by and large, it's mainly driven down to governance, either poor governance slip-ups, and occasionally also good governance.
Now, finally, what emerging risks are you seeing that could potentially impact the banking sector?
I mean, I think green transition is clearly an emerging risk. It's got a long way to run in terms of that story. There's going to be huge change for economies and societies, and banks clearly will feel that as well and be part of the story. So we're keeping a very close eye in terms of what banks are doing there, the promises they're making, as well. I think cyber would be a second one. It's I would say an emerged risk in that it's been around for a long time as a source of vulnerability. I think the banks themselves have got a pretty good track record at fending off some of the pressure they're under on cyber, and they get attacked every day. And it's a hard risk for us to judge. We like numbers. It's very hard to measure exactly how good a bank is on cyber, but it is certainly a topic that we our analysts are asking bank management about and trying to compare and contrast. So I think those would be the main two. I mean, the final one, I suppose, would be shadow banks, in that, there's been a big build-up of credit outside of the banking system over the last decade or so since the financial crisis. Understanding the linkages there in terms of where the risks lie, and also the vulnerability, the links back into the banking sector, is, I think, an ongoing piece for policymakers as well as us, frankly. And it could yet be that problems in the shadow banking sector yet come back to, as monetary policy works its way through, could still cause a problem down the track.
And in many of these conversations, we talk about digital and digitalisation. One big telco company recently announced massive job reductions based on what they see as the role AI is going to play. Is that something that you're thinking about at the moment as well?
Yeah, so we've been publishing quite a lot on digitalisation in banking for the last 4 or 5 years at least. It's clearly banks essentially are regulated technology companies, or at least they should be, because that's such a key discipline is the organisational setup around technology, and how that informs their cost to deliver and also their product set. So it's been a big topic for us with bank management for a long time. We've seen a lot of some banks work very hard in terms of on their technology. We had big question marks about will some of these new entrants eat the bank's lunch, particularly in some of the more juicy sort of fee-driven payment side of the market. That's happened to a degree, although with the size of the biggest banks and their budgets, as long as they've got the mindset to invest and to be forward-looking, I think ultimately they've been pretty successful at hanging on to their franchise and some of their strongest earnings so far.
Giles, thank you very much for your time today and for those insights as well. Really useful.
My pleasure.